Welcome once again to the weekly community call. Thanks everyone for joining. I think we are going through an interesting phase in the market. Would love to get everybody's comments on how you are feeling. But let's start with the usual. I think we go through the market status and we can discuss how it looks like. In general, I think we did talk about the key. I think we have been going through correction, like because market sentiment has been pretty much down. So it was kind of a roller coaster week. Today, we did see a pretty decent bounce, if you see here. But again, we are still sitting on pretty decent correction. So today, we have been talking, like last week, we had a good discussion around how markets were looking oversold. And we have yet to resolve all those oversold conditions, but definitely it's looking like we are trying to find a bottom. So we will try to see and look through various factors of how this may evolve. So S&P 500, as we discussed, it has broken out of the channel. It is below 200-day moving average, so definitely not looking good. Same thing for Nasdaq. Even though I think we had a much better bounce in Nasdaq, it has not made new lows after earlier this week, while S&P 500 made a new low less yesterday. So it's overall market is kind of consolidating right now. And as I said, today's bounce looked pretty good in terms of volumes and in terms of how market is trying to recover and find a bottom. Um, some of the stocks like Nvidia, if you see, has bounced back much better, and that is always the case. Like some of these market leaders, they usually set the tone much ahead of time. So this is a great sign, especially with today's move up. It has almost broken above last couple of weeks of levels, which also shows that there is definitely lack of selling anymore, and we are seeing some aggressive buying at the bottom. So this is typical for, as we say always, the higher quality stocks, which are leading this rally, and especially given that we have been talking multiple times that there is no fundamental change on the AI trade, the earnings were great, and so on. So this shows that we have pretty decent bounce here. So first of all, let's go back to the market. And the other big news, I think, this week was gold, which has made all-time highs again. Like we have touched $3,000. And if you are with us in Proflex, I think we have been talking about gold since last year when we had made our bullish call. And it has been, I think, one of the strongest rally we have seen through this last year, more than 1 year. And I think probably this is not over yet. We have been talking about the factors, what is driving it. It's mostly around the moving away from US debt, and some of these like China, Russia, and all have already been accumulating gold. And in general, there is in last few days, it's a rush to safety, you can say. So this is looking very good. I think we have been trading this for some time now, and I think the SPX. Right now, yes, just waiting for how it evolves. One thing which we shared, and I think we have been talking about, is the investor sentiment, which was at one of the lowest point. And this is like at the similar levels to the bottom of the bear market in 2022, which we have reached very fast, even with the 10% drop. So this is something which we discussed a little bit in our WhatsApp group, but also just to compare, right? Is typically when the bearish sentiment usually peak, that's when we form the bottoms. So that is another good sign that we have already reached the peak pessimism. And that shows that in past, what has happened is that we have found bottoms when sentiment is pretty low. So this is something which we will be monitoring, whether we again go through this kind of bottoming here and can we recover. So this will, I would say the current bounce is mostly a technical bounce we can qualify right now. And we are not seeing yet a confirmation till we retest the 200-day moving average, or we see the follow-up buying. I think we can see how aggressive the follow-up buying is next week. That will define. And by the way, there are key things to watch next week. We have the Fed meeting, which also is not this is not a usual meeting, but this will be this 4 times a year we see the dot plot, which is basically not only the interest rate decision, which is more likely that we will not have any major change in that. They are in the pause state, but also we are talking about potential projection of how many rate cuts they are expecting this year. If right now the bond yields and the markets are predicting maybe a few cuts again on the table, given the yields are going down. So that can be another factor next week, which can define the market direction. So that is something which we have to watch carefully. Um, on the Bitcoin side, I think it is looking a little better than S&P 500. It has not, it has maybe made a more bottom earlier this week in short term, and it's now testing and moving away above 200 and moving average. If we see it's not yet clear, I would say formed complete, reversal from here, but it's looking pretty strong, trying to break away above the 200 and moving average. So this will be interesting if it goes and tests the downward channel. Means, of course, the bull run in the Bitcoin can only be back when it breaks out of this downward channel. But right now, I think the key everybody's watching is whether it can retain 200 moving average. But in general, it's definitely not looking as weak as it was last week. So that's a summary. I think we are. Feel free to ask any questions or if you have any comments on what you are looking at in addition to these. Um, yeah. So I think if there is no specific questions, I think we can take up the topic and then we can maybe open it up for open discussion. So today's topic, I think, which many people are asking is, if you are like seeing this market correction and if market is in a turmoil, is it a good time to like sell the stocks, get out? So let's try to discuss that. So I have a few things to show. So as we know, right, in a long-term cycle, it doesn't matter. Like if you're a long-term investor, holding through bulls and bears market, I think this is very well-known fact that if you invest, you will always see markets recover and you will not have to worry about trying to time the market. But on the other hand, one factor to look for is, and this is a great article which I am referring to here, which talks about the importance of not missing the market's best days. So if you there are like if you miss the 10 best days in the market over a longer period of time, like they have taken around 30 years of period, you end up missing out on 54% of returns. Now why that is important? Because as it happens, the good days happen during the bad markets, like the best days when we say. So 50% of the good days or the best days of S&P 500, if you take, they have happened during bear market. So if you end up selling because you believe that market is going down and we are entering a bear market, you are more likely to miss out on the best days of the market. So in a long-term scenario, it's very difficult to time the market. So this is one answer I always say, is that whether you should time the market, probably not. You should not at least look to sell at a time when the market has gone down. Also, there are a lot of analysis people share, and I think one of the analysis we also shared in our WhatsApp group earlier. This is a chart of when after closing in correction territory, typically what are the returns 1 week, 1 month, 3 months, 6 months, and 1 year later. And if you can see here, 66%, 2 out of 3 times within 1 week of S&P 500 closing in correction territory, we have seen positive returns. And 86% times after 1 year, you have seen positive returns. So this itself gives you another data point that it's very difficult to uh, time the market by selling at the time of correction, especially when we have seen very hard cuts, like correction territory usually defined by 10% cut in the market. Yeah, and if that is a trigger which leads you to sell, it's a pretty bad way to time the market, because then you will lose out on this recovery. So combining this with the fact that the best days usually happen during bear markets, and you can in long run it can really have a negative effect. We don't recommend timing the market. On the other hand, you can probably, if you reverse this logic, because the best days happen during this bear markets, buying on a dip is probably a much better strategy, and you can actually allocate better during this time. That is how one should look at this, as an opportunity, because ultimately, as we have talked about, long term markets go up. More long term, we understand that it's always a good thing to be in the market and play out the long game. So that is one way to look at it. And even if you are our all access subscriber, you have seen in last 10 days we have identified a couple of good opportunities to buy at the local bottom. And if you see, many of those things will when we did the same thing last year during the yen carry trade meltdown in early August. So all these opportunities have usually resulted in pretty good gains also in short term, not just long term benefits, but also short term. So this is the one thing I would like to comment in terms of this question around what to do when a market is melting down. Is it something which you should do, whether you should exit or sit in cash? So I would say this data proves that it's not useful, or it's not going to help you in generating long-term high returns. Rather, uh, actually buying at these times or adding to your allocation usually gives you better returns. So that is just to take the one of the questions which came up as a community suggestions. We can take it up. Any other questions people have around this current market, we can take it up now. Looks like we are not seeing many questions today. So we can keep it short, I think, because we have been talking about this, and we will look forward to suggesting, how what else we should pick up. Uh, I see one question in the chat which says around what sectors or industries we should look at. I would say, means I'm not sure exactly in which context the question is, but let me put it this way, that today means some people talk about in the correction, should you rotate into sectors, like, you can go into defensive sectors and so on, but that is more about your own strategies and, how you manage your portfolio, because I believe that if you're investing and you're allocating into growth strategies, and if you're looking into growth industries, and the rate of returns in medium to long term are always going to be proportional to what that industry is going through. Like, so usually we suggest people to look at, always like, don't worry about the correction. I don't think we have. So let me put it this way: there is no structural change other than the sentiment and other than the all this noise around tariff, or there is nothing really changing from an economic perspective for most of the sectors. Yes, there can be micro impact of recent policy changes from the new administration that one can analyze, but that has been pretty much there while we were going up or down as a market. So I would say that will be a pretty interesting topic if we have any major headwinds or tailwinds which are coming because of the policy change into any of the sectors. We have not seen any major policy change, to be frank. Even from a tariff perspective, we talked about it last time, that there is no specific impacts yet seen. And first of all, none of the major tariffs have even come into effect. There are a lot of exemptions being given already. And most of the industry, I think, analysts are predicting that in the end, whatever is the worst case scenario on tariff will not happen, and we will more or less probably going to um, settle down on much lower rates than what is the worst case scenario right now being projected. I have one comment here saying that there is some comparisons being done with the Tariff Act in 1930. um, I would say, means this will be a very difficult thing if we are comparing with a 100-year-old economy and today's economy. While we can always look at some signs from that time, from what happened in 1930. I think it's a matter of whether you really believe, first of all, whether you really believe that the tariffs will be enacted in the manner which is where we are seeing today, in terms of the size of tariff, in terms of sectors and countries. There is always going to be, like, as we have seen multiple times, there's always a renegotiation. Second part is what is the real impact to the market, specific market players. That is yet to be seen. Um, so I would say that from a macro perspective, nothing has changed. No major, like, when we look at AI trade, do you see any reason why people will stop spending on AI? We have not seen any signs of it. If you look at on the ground, if you look at Google, or if you look at OpenAI and all, they're still launching new features. They are still updating and working. Like, their capex. We talked about it during the last earning cycle. Nothing has changed there. So at this moment, means when you look at macro, means inflation is actually coming down right now. The numbers have been looking very promising in terms of where the inflation is today. When you look at where we have in terms of, in fact, the interest rate projections are coming down right now. Yields are dropping. where market is actually predicting rate cuts now. So macro tailwinds are actually improving right now, while market sentiment is down because of the uncertainty. Market doesn't like uncertainty. There's a every day there is a there is a new headline on tariff. There's a new headline on whether there will be a tax cut or not. So all those kind of things are just market is deleveraging. And as I have highlighted a few times, this is not uncommon. This happened without any tariff, without anything, even in July, August last year. And market was like it was defined as a yen carry trade unwind. So from time to time, when the leverage increase in the market and the hit this tops, we get this correction. This time it was harsher. The sentiment is worse because of the headlines which people are reacting to. Um, yeah, please go ahead. If you have any questions, you can raise your hand or you can put it in the chat. One other question is around whether the semis will continue to lead and recover. I would say means yes, they are like, as we have seen today or last couple of days, Nvidia has already gone above much higher levels than the bottom of this cycle, while S&P 500 and others are still lagging. So we are already seeing Nvidia and some of the semiconductor like Micron and many others are already leading in last 2 days itself. So that shows the sign that there is nothing changing in the market leaders. Yes, whether the market will make new highs or whether it will completely reverse, because right now we are just going through a technical bounce and we are bouncing from oversold levels. And whether this was absolute bottom in near term or whether it is just a local bottom, we will probably again test 200 moving averages or another bounce, and we may have some more negative cycle. Now, let me also talk about like when we talk about macro, there are a couple of other things which I'm watching. Is there has been this whole stimulus which is going around in China or in Europe is now talking about use printing money, you can say spending, increasing their spending because of this whole defense spending bill they are putting together. All this will have a trickle down effect through the rest of the year, as we always talk about global M2 money supply. So, and global money supply is expected to increase. It's already increasing in last couple of months, and there is usually a lag factor. And when the money supply increases, usually the asset prices go up. We are seeing that impact in gold already, which is, of course, a safer asset today versus US equity, which is because of the tariff uncertainty is probably going to lag. But ultimately, it pulls up everything. When the money supply is increasing, all asset classes do well. And that is what I think we have to watch also, that we are still in an easy money policy, and we are now seeing some of the major economies going into easy money policy again. And next week, Fed's meeting, this is why it's very critical. If they also show dovish stance, and then we are going to have a trifecta of China, EU, and US going towards easy money policy. And if you see, even from the last FOMC minutes, there were discussions around reducing QT. So all these factors are pointing to that macro headwinds are not there. In fact, we are expecting more tailwinds, and this can actually help the market. So other than, I would say, the craziness of this administration's tariff on, tariff off, there is no real fundamental issues which we see in the market right now. So any other questions, guys? So let me know. We can take it up in the chat, or you can raise your hand and we can bring you in. Yes, go ahead, please.
So, staying on the economic side of things, not the political side of things, right? Uh, I mean, what seems to be the end game here that the administration seems to be playing out by laying off people, again, staying the economic side of things and the competence side of stuff, that that will that damage long-term US, technical and innovation capability, and therefore hurt economically?
So I think from an economic perspective, my view is that they are trying to convey two messages. One is that their focus is on improving the deficit and the debt. situation. So they're doing it in two manners. One is that they're talking about trying to get their long-term yields down, which will help refinance at a more credible manner. Because right now, what Biden administration did, and what Yellen, let's talk about Treasury, not even like from economic perspective, what Janet Yellen did, she was actually increasing the short-term bills. So you're talking about less than 1 year bills being highest amount of new debt issuance when the debt deficit was increasing. What that did is that every year it is compounding. Now imagine you're paying 4.5% interest rate or a 5% interest rate, and you are basically compounding means you have to every year you have to reissue them because they are less than 1 year duration. Typically you need to balance it out with a longer duration. So they have stated their goal to be, can we bring down 10-year treasury, and then can we refinance in a more sustainable manner? Because what we have been doing is not only our rates were running high, we were using a almost, think about, you are running on credit cards. Like US government was running on credit card by saying, okay, let me just take 6-month loan and 9-month loan, and let me pay the interest rate at a very, very high rate, and let me keep increasing my debt. So they are trying to define a path where 10-year yield or long-term yields can come down so that we can have a sustainable debt. Second part is they are talking about, when you talk about cutting jobs and cutting federal spending, that is purely trying to identify, are we like, because if you see the comparison between 5 years ago of how much US government spending was and today, it's 3 to 4 times more. So the question they're asking is why the spending is going up at that pace. Means yes, we needed extra spending during COVID, but that was a one-time event that is gone behind us. Why cannot we bring down? And supposedly they are trying to talk about wastage and corruption, which they are trying to identify, and inefficiencies in the government. Now that is something which is questionable because first of all, it's very difficult, to even find and fix those things. That right now, whatever we have seen is probably a few tens of billions versus we are talking about trillions of spending. So it's more about signaling, I would say, rather than actual results which they're achieving at this moment, where they're saying, yes, we care about deficit. And usually, as you know, in economics, signaling works. Like where you're saying we are not going to spend crazy, when we are going to cut spending, that also means that there is a very less likelihood of passing any bills which are going to increase government spending. So from that perspective, I think it's a signaling to bring down the longer term yields to make the debt sustainable. That's the policy. Now, what is the economic impact? The economic impact is long term great, as everybody can understand. It's obvious that if you can bring your deficits down or if you can bring your long term rates down, it's going to be great. But short term, there was a lot of analysis which has come in, is that last 3-4 years, all the boom, asset boom, and everything was because of the spending. Because your GDP, there was one analysis which was pointing that 40% of GDP was because of government spending. If you remove that, then GDP was not as great. So that is definitely going to have short-term impact, and that is what market is worrying about. So it's a kind of a
Okay.
balancing act, and I think what market is hopeful of, and as I have been pointing in the chat also in WhatsApp also, that the next big thing which market can take as a positive, which I think the administration is talking about, is that while they are going to have this less government spending and there will be some kind of a slowdown, they're going to balance it by tax cuts. So they are trying to extend the 2017 Trump tax cuts. They are trying to further reduce some of these election promises about no tax on tips and so on. So economically, they are thinking they can create a boost in consumption by giving tax breaks while being more fiscally responsible. So that's the stated policy. Now, whether they achieve it or not is a question mark. Whether they are able to really cut the spending, whether they are able to control the deficit, because we are talking about in this year we have 7 to 9 trillion of debt which has to be refinanced based on how much spending they do and how much is deficit. That is the range which has to be financed this year itself. So that's not going to be easy to cut down. Like you cannot just bring the debt down so fast when your interest expense are so high, your defense expense are so high, and so on. So that is, I think, what market is observing, and market is just taking the pessimistic view right now. And I think it's a matter of whether it will like really bring down the economic activity. Right now, we are not seeing that. While I think consumer sentiment is down, and we are seeing the inflation coming down at this moment. So, which is a good, probably one of the good signs. except for the fact that whether it will have a trickle-down effect of economic slowdown, that is still being evaluated.
Okay, thank you.
So I think overall, to be frank, it's a pretty interesting discussion right now. If we leave the politics aside of, I know there are a lot of extreme views on both sides, but I think we need to understand it's a different policy, in a different philosophy. We are taking a very hard right turn on philosophy change. The democratic policies were more about, welfare and, spending. Government spending was always going up, and Republican policies are going into more, corporate driven, where you reduce spending and try to bring efficiency, so called, while providing boost to the private sector. So I think that is where we need to understand whether in short term we have to watch the parameters. But I think at this moment, my view is that if the tax cuts don't get passed quickly, the pessimism will continue, because if you're talking about spending cuts, if you're talking about all these tariffs, there is nothing positive for consumer demand and consumer sentiment. So the only positive things to balance is tax cuts, and that bill will be very critical. Second thing is the FOMC next week. If the interest rate cuts are back on the table for 2025, that can provide a little bit of boost to the economy. So these are the two positive news I think we can expect to balance out and to get on the path of growth again. If those two don't materialize, then this bounce is just a technical bounce, and market is still in a pessimistic mode. So that is the fundamental, I would say. And of course, remember that the market is also driven very heavily by some of very, very few companies. Like even in last 3 years, this is the AI market. So any of those positive news and the next earnings cycle in April and May will also be a big boost to the market if we can continue on the growth path. So there's a lot of things to look forward to in coming weeks of whether this market can sustain and probably make new highs or even try to get to the same levels. But I think the worst is priced in my view, because right now people there is nothing fundamentally changed other than the sentiment. So sentiment is already pricing in the worst case scenario.
No, so one thing, last week, right? I thought Treasury Secretary or someone was saying one of the interviews he was saying they're intentionally trying to slow down things. Someone had asked them, because some of these things they are trying to do by design. I think it will help with some inflation or some other number, maybe.
Yeah. So I think when they say, I don't know if any official would say that they're intentionally trying to slow down. What they were probably trying to
So
say is they
someone
say,
asked him and he acknowledged it was.
yes. So let me tell you, the thing which I saw was something like whether we are, the question was, is government, like their answer is always typically like government spending based economy is not a good economy. So yes, they are trying to slow down that part of the economy, which is purely spending based. What they are saying is the real economy growth is when there is a private sector growth, when there is a industries growth, when there is a job creation by private sector, not by spending, because you're taxing people to spend and create a fake growth or fake GDP. So that is what they are trying to slow down, and they have been acknowledging over and over again that that is definitely their goal. But I don't think they will ever say, or any economic policy can be designed to slow down by, that is the job of, if it is too hot, like which Fed was doing by keeping the interest rate high and so on. Yes, that's what they do. But that is never to slow down the economy, but just to reduce the overheating. So let me put it this way. So yes, I think the current administration is very clear that, and in fact, I think one more comment which they had said is they will stop tracking government spending inside GDP. So they are actually trying to redefine GDP itself, because their goal is to reduce the government spending. So they will re-baseline the older numbers, because what they are worried about is that politically it will look very bad if we are into recession because they cut down government spending. So they are going to probably redefine that GDP number also, how it is calculated, by removing older government spending. And I think that's why they are creating a case of that we need to cool down, and we don't have to celebrate the GDP or any kind of economic growth we are creating because of government spending, because that is not efficient. and that is waste of taxpayer money.
So have they set? I know that you were saying the 30% number for GDP for government. Have they set some target on like how much they want to take it, 20 or 25? I know you're right. Like they were saying, it's very high, 30 or 40 something, right? Do they have a target? They have said, I don't know
I
that's
think that the only target on the I don't think they will ever give a target of reducing GDP till they redefine the GDP. The target they are talking about is a 1 trillion in spending cut. That is what I think since day one, the Dodge and this Elon Musk team has been talking about, that 1 trillion is their goal to achieve per year, 1 year, 1 trillion if they can reduce the spending, which I think is kind of super ambitious, because if you look at the components of the spending itself, the major part is interest rates and defense spending and so on. And even in the last week interview, I think Trump had said that there is no plan to cut defense spending as of now. So the only thing they're cutting down right now is the aid to, like, for example, the foreign aid to the in the defense, but not necessarily reducing the defense spending of US itself. So that is looking like a kind of a number which they're actually achieving. The real numbers which are coming out is a few tens of billions, or probably that's what they have achieved till now. So it will be, as I said, like I think these are all kind of paper dreams, to be frank, some of them, and that is more like a signaling and rather than something which they can really achieve. But I think overall things are working for now. Like the US 10-year yield has come down since Trump's inauguration by almost 40 to 50 basis point, which is basically a signal is working, that they want to work on slowdown and long-term yields to be brought down. One question I see in the chat is, isn't the slowdown good for lowering our interest payments? Yes, means I think that's a fair point, because most of the mortgages, like if you see also the just like 10-year yield is coming down, the term premium of 30-year yield is coming down, that's your mortgage payment. So your that is where most of your base of your mortgage payments will be, unless you are on ARM basis, which are mostly SOFR based, which is short-term rate based. But I think bond yields definitely are coming down, and the slowdown is very useful for that, means interest rates will come down. And also, I think there is some discussion around limiting the interest rate on credit card and all. I don't know if that works in a free market like US, but basically, even if they don't do those kind of bills, in general, the cost of capital, as we call it, like cost of capital, whether it's uh, your card rates, whether it is everything comes down when the bond yields come down. So definitely that is going to help with the interest payments and maybe affordability for the house and so on. So those kind of things will benefit. So that's always a balancing act, right? This is where the economy automatically balances out, where if you're slowing down, the yields will come down, which will create some boost. So there is always, by definition, there is a balancing factor there. But again, the question is whether, biggest issue is inflation, because that drives sustainability of low rates. If you see that we had a tech-related deflation in when we started 2010 onwards, after 2008 crisis, we had a 10 years of very low interest rates and very low inflation. While the economy was booming. Can we get back to that? That's a question, because right now we are no longer in that near zero kind of interest rates. And that is the biggest question mark, whether we are anywhere close to that, no for sure. So whether we can at least come down from the current levels, which is we are in a flat yield curve. I think we discussed it a few times in this call. Right now, our short-term rates are 4.25. Our 1, 2, 3 year mostly are around similar time, similar interest rates. We are talking about 10-year yield now in 4.3. So we are basically in a flat yield curve. Means I'm sure you must have heard about this yield curve. Basically, term premium is the only thing which you are paying right now. So currently, most of the short term is pretty much in the same ballpark. So market is kind of uncertain and in a holding pattern. Fed is in a holding pattern. So for now, I think if 10-year yield is coming down, that means they are probably accepting the fact that we are not going to be crazy with our deficit. We are not going to be, and that is the signaling which the current administration is giving and trying to keep our rates down. So I think this is a good discussion. I think we can talk about the policy impact in a more mature way rather than I think the whole panic and hype around these political discussions and in the news cycle right now. But I think in general, the biggest issue is uncertainty in the market, which is creating this kind of a situation. Yes, please go ahead.
Yeah, I had a question on trading,
Mhm.
which is different from economy. So my question is, when traders trade, so they may have a total portfolio, let's say X, but for each trade they'll limit the risk, right? So they will, there is Kelly's law and many other formula which will say, don't put all your eggs in one basket, right? So generally, what percentage of portfolio is actually deployed, or what
Uh,
is the best strategy for that?
Actually, yeah, I mean, it's an interesting question because, to be frank, there is no single answer for it, and it depends on every person. Um, Typically, people think in a manner of where you are looking at medium to long term. Means I think the traditional uh, knowledge says that you should, if you are a long-term investor, if you're young in your life, you can invest more into in growth, like equity and all the kind of speculatory investments, which can give you short-term losses, but in long run they are known to always give you high returns. So typically people used to have this model. I think things are evolving over time. People have like now people are talking about staying always invested. Then you can pick sectors, right? You can be more aggressive sector versus defensive. You can play dividends versus growth stocks. So I won't say there is an easy answer for how much to be deployed. It's very heavily dependent on your needs and so on. And this is not part of this call, I would say. Means it has to be discussed as a financial advisor and your specific discussion and your specific scenario. But if the question, let's turn it around to be make it more useful, is if you are saying yes, this is the part I want to be in the market, and this is the size of the investment I want to do in the market. I think that can be a good discussion to have, like how much of it you deploy, do you keep in cash for opportunities like these where market is down? I think that's a great question because as we discussed also in the earlier in the call, that deploying at a dip after a 10% or 12% dip, you will give you much higher return than always just owning the market, and that is proven over time in longer run. So in those kind of things, I think one way to think of it is you can of course do allocation like that you are when you're not comfortable, when you think that market has run up too much, you can allocate certain portion in cash. The other way to think is if you are a little more advanced and if you are able to manage your portfolio with a leverage, you can probably increase leverage at this time. Like, and I'm not suggesting you can go 2x, 3x leverage. I'm talking about more reasonable leverage, like even doing from 1x to 1.1x leverage or 1.2x leverage, which is much more reasonable way of, deploying using margin or leverage. You can really take advantage of these kind of drops. So again, means disclaimer here is that yes, I'm not trying to be a financial advisor here because this is not the role we are playing here in this call. It's mostly for educational purposes. But what I'm trying to say is that that's what mostly people do in these kind of scenarios. Like, and if you use these kind of things in a more responsible manner, you can do either way. Either you can use leverage in these scenarios, increasing or decreasing, or you can also create your own models where you say, I will usually be invested 70%, but in these kind of drops, I can go and invest 80%, 90%, or 100% of my capital. So those are some ways to think about it. Does it answer your question? Let me know. But I think overall, basic idea here is that we are looking for, trying to learn through what people do and share those rather than trying to make this call. Because as I said, these are very individual dependent. These are not something which, and some people are more growth focused who can say that my risk appetite is that I think long term. Because remember, the risks are always short term because market is very unpredictable in risk assets. The drawdowns which we are seeing right now can shake you up, and if you exit at the wrong time, you can book it. But if you, as we have seen over and over again, if you are a very long-term investor, these things don't matter. These become noise in the bigger picture. There's another question in the chat is, do the expected return actually change substantially if you increase the investment during downturn? Oh, actually, this is a very interesting question. And to be frank, there is a lot of data around it. Like if we go back to the table, which we were sharing earlier, let me just open that again. It's as simple as this, where we say that if you deploy after 10% when you are in correction territory, the average and median returns are 15 to 18%. Versus if you see the typical S&P 500 1-year returns are much lower. I think it's in the somewhere around 10 to 12% in the recent time and in long-term time. So this itself, you are seeing that you are able to beat the markets handsomely if you are deploying. And this is just a random correction territory when we're talking about. Means if you are timing specific stocks, like when we talked about earlier, like if you look at NVIDIA is already up 15%. Forget about 1 year later. Even within a week, it is up 15% from its bottom. So that itself gives you, if you deploy at the right time, the amount of stock picking and how much you can make in your portfolio in the longer run, there's no limit to it. If you increase or decrease the deployment. So this is what it's a great topic. It's not straightforward, but let me put it this way, that active management, or even forget about active management, if you use hedges, if you are able to buy, like we always, if you are part of some of our subscription in All Access, or if you are part of Proflex, we are a big believer in using options, which reduces your entry point in such scenarios. You can use volatility to your advantage. But even simplifying for a typical stock buyer, if you're not comfortable with options, here itself, it's a great sign. Means some of these stocks have already moved up a decent amount from their bottoms. Like even something like, of course, these are volatile stocks, means it's very difficult to time the market. I'm not suggesting that it is something which anybody can do. But if you look at like Micron, means it has gone up. This stock has also gone up more than 15%, 20% in last few days itself. But again, as I said, even at a S&P 500, which is much easier to play, this data point suggests that 86% of the times after you deploy more capital, you are getting better than usual returns, which is itself tells you that yes, you can generate excessive returns by buying it these times. And that is something which we always discuss. Like, this is what we talk about when we, like, how do the hedge funds generate higher returns? How do they are always timing the market. They are trying to hedge it. They are trying to reduce their cost of entry. All these things are pretty common practices which people use to, generate better than market returns. So these are, I think, much more complex topics. Maybe we can pick up specifically some strategies around it. I would prefer if it is in more like, a more interactive session than this kind of a call here. But mostly, I would say that market is very complex thing. But if you have some specific strategies which you can use to reduce your costs, you can make options. As I always say, is a great tool to do it. Because you will never know when is the bottom, but options give you a way to find the bottom by defining your cost yourself, by selling puts or to acquire stocks, or trying to sell calls against it. So those kind of things are very useful in timing the market sometimes. So I don't know if I answered the bigger part of the question, but I would say yes. It's a great way to always look for these opportunities rather than being shocked by like, for example, I remember even there was a lot of discussion around there is people who are putting together tables around Bitcoin. Like if you believe in Bitcoin, if you're investing for long term, people who have bought after deep correction when nobody's buying, they have generated way higher returns. But again, as I said, like if you look at long-term charts also, you will see that there is no real problem just holding it all either. So it's more about your comfort level. I see another question here on the chat which says NVIDIA conference impact on the stock price. I think it may be in the top of the news cycle in terms of their products and so on, which may help next week. I think that's what is happening. I'm assuming you're talking about the GTC. And I think that is always helps. We have seen that previously with Apple when they have their developer conference or any such thing. Usually there's a lot more positive news flow because most of these conferences talk about new product, new APIs, new stuff, which usually generates excitement. But I think it is so well-tracked stock and it is so well analyzed. I don't know if that will have enough impact to change rest of the market discussion or rest of the analysis. Because I think it's very clear right now, the biggest sales cycle of NVIDIA is in the data center market. And there is nothing major expected in terms of product launches in this conference. But I think it is, as I said, it's just generally the sentiment is better in this time, so that should have some help. But I won't say that we should assume that it will go up because of that. And we are already seeing that it is leading the market. So I think the bigger factor is whether we have reversed for good if the money flow. So let me also tell you what are like few things which we were reading. Most of this selling was momentum-based selling. It's very similar to what happened in July, August last year. If you might be reading some indirect analysis of Goldman Sachs and some many other analysis which came in that a lot of hedge funds were selling, or some of, I think, Citadel or some other big funds have lost quite a bit of money who are the market makers. So I think usually whatever the reason be for the correction, in modern world, this momentum triggers can accelerate the move in both directions. So what we saw in last 2-3 weeks, we had pretty accelerated fall because of that. And if recovery is sustainable, if we get a little bit of buying, it can also trigger the buying in a similar manner because people have to catch up, like whether it is leverage ETFs, whether it is momentum market makers, whether it's option trades, all of these modern day instruments, they usually accelerate any directional moves. So today was one example. I think we had pretty decent recovery. But I think we are not yet breaking the levels on the upside. But as soon as we hit any of those levels, the recovery will be much faster. So I think right now, the technical nature of the market is much more important than any fundamentals, because we have discussed this last week also. None of this drop can be justified with any change in fundamentals. Most of it is sentiment driven, and most of it is momentum driven, because once the sentiment was of uncertainty triggered the market collapse, we saw the collapse accelerating because of the momentum triggers. That's my take on the current market correction, rather than saying that, oh, fundamentally we are in a different market now. Because if you remember, we were always, I keep going back to the fundamentals. What are the fundamentals? We are only seeing Max 7 going up, which have been the bulk of the rally in last 2-3 years. None of them are in bubble. We are talking about PE ratios of 25 to 30, or maximum, I would say 35, and forward PEs of much lower levels, like some of these companies like Google, Meta, and all, they are like below 25 forward PEs. Even Nvidia is now at the lowest point in this correction was below 25 on forward PE. So some of these are really cheap stocks from a valuation perspective if you compare them with their growth, with their historic growth and even recent growth. So it is not I think we have discussed multiple times that this is not same as .com. It is not like we are sitting on a huge bubble. Valuations are on higher side, but not in a bubble territory. So fundamentally, nothing is changing unless we settle down on the policies and any major direct impact, which we can see. So that is where we are. And I think technically today's bounce was great. Monday and the follow-on buying, and especially the Fed meeting next week, can actually help us quite a lot. And I would say the biggest balancing act of this administration is the tax cut and tax bill, which I think they better hurry up if they want to save the market. But probably that will take time because they are being very ambitious with that also. So let's see how that evolves. And that would be my summary on what to expect from the market in the next few days or weeks in terms of where we head. So in very short term technical, and in medium term, how the money supply changes in terms of whether it's the interest rate cuts or QT tapering or the tax cuts. I think these will be the triggers. All right. So I think we are on the top of the hour very quickly. So another one or two questions we can take. Otherwise, we'll wrap up this week. So I think in general, a quick comment, I think, because we always have something about the crypto and Bitcoin. So I did talk a little bit in the start of the call. If there are any questions on that, I think we have discussed that Bitcoin is following the market right now, the money flow and the general market sentiment. The Bitcoin ETF outflows from US are very much correlated to the outflows in equity market. So that can change based on the market momentum in US markets. Other than that, fundamentally, it's only improving for Bitcoin with the strategic reserve already being set up, and there are a lot of interesting stuff happening in that domain. Some proposals around bit bonds to how they can issue Bitcoin linked bonds. There are quite a few companies which have been getting into combined Bitcoin plus real estate investment models. So the amount of adoption in institutional products of Bitcoin is going really through the roof. And I would like to, means we are probably going to cover it in our Crypto Pulse newsletter for the subscribers in the upcoming cycle. But I think overall, this is a great time to consider allocation into crypto. And do reach out to us if you're looking for any help in that regard. But in general, I think right now, technically, we are looking at probably sitting at this 200 moving average we discussed a few times. And I think that is going to be very critical to maintain for further collapse of in the price, because that still works. I think the demand and supply flow still is heavily correlated, and you can see it in the technical charts. So all these things are what we are watching very closely, and we would love to discuss, or if anybody has any questions on that. But other than that, I think I didn't see anything else in the chat or any other hands. So we will wrap up for today. Thanks a lot for joining, and all the best, and happy Holi to all of you. Let's talk next week, and stay connected in the chat, and please let us know any other topics you would like to discuss. Thank you. Bye-bye.